Hello, everybody. Welcome. This is a series of financial statement analysis videos. We're going to be looking today at two that are really kind of referring to how leveraged a company is. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. During the presentation, the author, I will include references to websites, including but not limited to Investopedia. These references are the copyrights of those owners and not of the authors. So let's go ahead and get to it. When we look at financial leverage, and this is kind of part of our DuPont formula, that if you look at basically when we disaggregate return on equity, we basically see return on equity is, well, it's net income divided by the average shareholder's equity. But if we look at this a little bit more carefully, we're really kind of looking at, well, when we look at like net income divided by average total assets, and then we have average total assets divided by shareholders' equity, how can we take that return on equity and just go a little bit more deeper? Now, when we look at financial leverage, the ratios I'm going to show you right over here are not necessarily part of the DuPont, but actually they're going to give us just some kind of like background in terms of going through and, really saying, well, how much more can we borrow? And then how do we pay the interest on that debt? And the first one we're going to look at is over here, and I will leave the links to these in the comments below so you can kind of find these on your own. So the first one of these is basically how much more can we borrow, right? So the first one here is how leveraged is a company, total liabilities to equity. So the first thing I'm going to go through over here and take a look at is given, and I'm going to do these for Target. And if you're watching my terrible Excel skills, you should take the Excel courses we offer at Irvine Valley College. That's my shameless plug. I need to take them myself. So the first thing we're going to kind of go through and do is say, okay, what are the total liabilities of Target? Now, what I've done is using the magic of sec.gov. And if I come over here and take a look at Target, what I can do, and I have other videos, so if I'm going too quickly, feel free to, send me and leave a comment below, and I can provide you a link to looking up SEC filings. So with Target, when we're going down over here to kind of look at, go to item 8, and when we look at Target, what we're trying to go through and do is to say, okay, our total liabilities were approximately, well, it doesn't tell us directly. You got to love that. So it's about 19 billion plus about 22 billion, or roughly 41.9 billion. And our total equity is going to be roughly about 13.4 billion. So let's go through and do these ratio computations. So one of the things is that within the SEC filings, I can download the financial statements onto Excel. Again, if you want to learn how to do that, feel free to leave me a message in the comments below, but let's go ahead and go to it. So when I look at this over here, I'm going to go to the Target balance sheets, my total liabilities are going to be my total current liabilities plus my non-current liabilities are roughly about 41 billion. And this is for as of February 3rd, 2024. As of January 28th, 2023, this would be right over here about 19.5 plus about 22.6 billion, or 42.1 billion. Then I have over here my equity. My total equity over here is another way of saying total shareholder investment. So here is my debt to equity for right over here are my liabilities to equity. If I put this kind of the computations over here on the side. Okay, so coming right over here. Okay, so my debt to equity ratio is going to be 3.12. And my debt to equity ratio over here for target will be about 3.74 or 3.75. So coming over here to look at what the results are, my debt to equity over here for target is 3.12, basically as opposed to 3.75. Obviously, the higher that this number is, the more leveraged we are, meaning that we have more debt than we have equity. Now, to kind of show you a really extreme example of this, what I'm going to go do now is basically show you our friends at the Home Depot. And when I look at the Home Depot, and I'm just going to pull up one of their more recent financial statements. So the Home Depot has liabilities of 92 as of July 28th, 2024. They have liabilities of 92 billion, 426 million. Okay, and so when we look at this, we'll just put this over here. 92 426. Okay, let's make sure I got that right. Perfect. And then they have equity of 4.4 billion. Okay. So when we look at this for the Home Depot, and when we look at their debt to equity, and I'm giving you this example because it's very extreme, but it's worth noting their debt to equity is 20 times, 20.9 times, meaning that this company is highly, highly leveraged. Okay. Now, you may be saying to yourself, why is the Home Depot highly, highly leveraged? The Home Depot, for all intents and purposes, they make a lot of money, right? They're over here for just the 3 months ended, they made 4.4 billion, made 8.1 billion for the 6 months ended July 28th, 2024. So they're a profitable company, but why do they have so much debt? And this is why like running all these ratios can be so important. I want you to pay attention to something down here, which is something we call treasury stock. What exactly is treasury stock? Treasury stock is when a company repurchases its own shares. Now, when you look at the Home Depot and we look at, well, why would they want to do that? Well, it's because over here they issued initially 1.8 billion shares, but now they only have 993 million shares outstanding, meaning that they've repurchased roughly getting close to about half of the shares that they have out there. And this is what creates this really funky looking balance sheet. If we were to add back 95 billion to the cash balance of the Home Depot, and I'm not saying that that's even possible to do, but all of a sudden, you would basically say, well, wait a second, if I added that back, now my debt to equity actually looks even better than that of Target because the equity is more than half, or 95 plus 4.4 is about 99 billion. I Wow, this company looks great if I would have never bought back the treasury stock. However, the reason why a company like the Home Depot may choose to basically do stock buybacks for whatever reason, there's a lot of different reasons. Again, video is my opinion. Use that to kind of further your own knowledge. Is when it comes to earnings per share, when I have fewer shares outstanding, basically it's going to raise up the EPS. So by buying back my own stock, all of a sudden my earnings look like they're much, much better. And because they are, because there's fewer shares that are outstanding. So that is the debt to equity ratio. I want to encourage you to kind of go through. Higher debt equity ratios suggest more risk, while a low one may indicate that business is not taking advantage of debt financing to expand. And again, the interest rates have gone way up compared to what they were a few years ago. So that may not necessarily be a bad thing. But this is kind of when you're going through and looking at this, this is why Investopedia is so amazing. I'll never forget a few years back, I had a student of mine said, well, I learned everything about investing by going to Investopedia. Those were her words, not mine. But again, it's a great resource for you to use. So that's the first ratio we're going to go through and look at, which is the basically the debt to equity or liabilities to equity ratio. Next one is going to be times interest earned. What exactly is times interest earned? Well, the times interest earned ratio is essentially a ratio that we can kind of use to basically better understand how a company can basically meet its current debt obligations. Meaning that, well, are they generating enough money to basically pay back the interest? And if we look at the Home Depot once more, I come over here. So Home Depot has a lot of debt, right? So the Home Depot literally has about 51 billion of not of long-term debt, right? So it's a lot of that's be any debt that's beyond a year. It's a lot of money that's owed. But when you look at the interest expense relative to the operating income, you're thinking, huh, wow, they're pretty well covered on this. They could basically pay back. Their coverage ratio of this is actually pretty good. If I'm taking my earnings before interest and taxes, dividing it by the interest expense, it's a pretty good ratio, right? They're able to cover their interest payments. This is in contrast to a company like Rivian. And I'm not trashing on Rivian because they haven't bought me a car yet. But if we look at Rivian, does Rivian have a lot of debt? Well, let's find out. So over here, they've got long-term debt, basically 4.4 billion. Actually, let's look at the more recent one. 5.5 billion as of June 30th, 2024. So Rivian has a lot of debt. They've got total assets of about 15 billion, debt of about 5.5 billion, total liabilities of 8.5. Now, obviously, Rivian recently took on an investment for Volkswagen, so they should be a little bit better in the future. But here we go. When we look at Rivian, Rivian has been selling their vehicles basically at a loss. Now, at some point in time, as they go towards mass production, this should flip at some point if they are successful. But when we look at this, when you kind of look at their costs, like basically the kind of the creep, here you've got, well, you've got interest income, which is obviously they're investing their money, but then you have this interest expense. So the times interest earned ratio for a company like Rivian would not even be applicable because they can't make their interest payments. So that's something just to kind of go through and think about as you're looking at, this is why doing all these ratios is so important to kind of go through and do. So when it comes to times interest earned, right, Rivian is it's not good. However, when it comes to the company we're looking at, which is our friends at Target, right over here. So basically for Target, and I'll move this over. So my ratio here, which is earnings before interest and tax, another fine way of saying essentially like operating income. And what we're going to do over here is we're basically going to go to my income statement. And my income statement, we'll just call it operating income of 5.7 billion for the year ended 2/3/24. And over here, our operating income for the 12 months ended January 28th, 2023 is 3.8 billion. Okay, so now when I come over here to go through and look at this, now I'm saying to myself, okay, what is my amount of the interest expense? Now, what's really important is that you show the interest expense not net, meaning that it's not being offset against interest income. You have to show the amount at gross. So what we may need to go through and do is look through those financial statements to see what we can discover. And of course, over here, we've got net interest expense. And what I'm going to do really quickly is I'm going to pause and we're going to go look at those financial statements for Target. So here I'm on the SEC's website. I am looking through the financial statements here of Target. And what I'm trying to go through and do is to make sure that my interest expense is not necessarily net, that it is the gross amount of the interest expense. So what I need to do is when I look at the balance sheet, what I kind of go through and see in this balance sheet is that right over here, my net, it says net interest expense of 502 billion. So 502 million, not billion. Okay, so that sounds like our US government. No, actually ours is much higher. So we got 502 and 478. So let's write in those numbers. Okay, so what I want to do is to figure out what is the real amount of the interest expense. What did they include in these numbers over here, which may be kind of throwing things off. So I'm going to come over here and I'm basically going to say, okay, I'm going to do a control find, net interest expense. Okay. So it says over here, 502 compared with 478. Okay, I'm just doing a search here. Net interest expense, okay. Net interest expense, okay. Now, I see this over here, the effective hedges, right, of on net interest expense. I'm not going to try to explain hedges to you. That's for another class. But go through and explore it. Now, what it shows over here is it says gain on cash flow hedges. So I've got interest rate swaps designated as fair value. And then I've got gain on cash flow hedges recognized in net interest expense. And I've got over here 24 and then 4. So what I'm kind of thinking is that when I look at this, and let's just see here, the way I'm going through and interpreting this is I'm going to kind of say, well, if it's a gain that's recognized, it means that I want to exclude those gains. So if I come back over here, right, and basically gains included, this should be reducing this of basically 24. And then this amount over here is at 4. So my interest expense gross to exclude the gain, I'm going to go ahead and add this back in. So it's not going to make too much of a difference, but I just want to kind of make sure that I'm going through and capturing this correctly. So I'm going to go ahead and put this down over here because I don't want gains to be included this because a gain is going to be reducing my amount of interest expense. And I want this to be at gross. So coming over here to look at this is at 10.84. So basically we've got 10.85 times. So we've got pretty good interest coverage. And then over here, it was only at 7.98. So Target during 2023 dramatically for the fiscal. It's always weird with these retailers. They improved, going year over year. They're obviously making more money. So they have in fact improved. So coming over here to my times interest earned. So this part over here is going to basically be 10.85, and this is going to be 7.98. So These two ratios, this is not part of the DuPont formula, but the reason why we want to explore these first is to really kind of go through and say to ourselves, well, what does the debt of this company look like? How leveraged are they? And running through all these ratios, this is why it becomes so important to do this. So, in any event, I want to thank you for being here. I appreciate you liking and subscribing to the channel. If you have any questions or you'd like to see other videos, or if I'm wrong, feel free to leave a comment below. And I look forward to seeing you on the future videos. Have a great one.